right. Good afternoon once again, and welcome to our first Monetary Policy Forum of 2025. It is a great pleasure to have you here with us. My name is Mapule Mofugeng, and I'll be your program director for today's event. So here at the SAB, we value any opportunity to engage with you. Today, we are excited to launch the first of the two monetary policy reviews that the SAB publishes every year. This publication serves to inform the public about the SAB's assessment of global and domestic economic development and to outline how those developments inform and guide policy decisions. So we will begin with the opening remarks from the Governor, which will be followed by a presentation by our Head of Research Department and Chief Economist, Chris Lovold. After the presentation, you will have an opportunity to ask questions. So for our guests here in the room, mics will be available should you wish to ask a question. So please raise your hand and you will be assisted accordingly. We will also be monitoring questions submitted online, so you are welcome to make use of that platform as well. So without any further ado, I will now hand over to the Governor of the South African Reserve Bank, Lesetja Kganyago.
Thank you very much, Mapule. Good afternoon and welcome to the first Monetary Policy Forum for 2025. We meet here today when the world economy is in economic turmoil. The confidence regarding global economic developments we projected in October has largely evaporated. And this has been displaced by heightened economic uncertainty due to trade tensions. Here at home, we have seen significant progress on disinflation since last October, along with notable headway on the energy and logistics front. With inflation and inflation expectations better behaved, we lowered borrowing costs, and this will support economic activity. However, risks to domestic inflation and growth have risen markedly since the start of the year. The South African Reserve Bank remains steadfast in its commitment to protecting the purchasing power of the rand. We do this by ensuring that inflation and inflation expectations are anchored and price stability is maintained. As the South African Reserve Bank, we contribute to growth and employment mainly by reducing macroeconomic and financial instability. And this we do such that we create a more conducive environment for conducting business in our country. We will remain cautious as we navigate a highly volatile global macroeconomic environment. Here is one fact we know to be true. South Africans, and indeed consumers the world over, hate inflation. Importantly, high inflation is anti-poor. We at the South African Reserve Bank take our responsibility to protect the poor seriously. We, however, contend that while inflation has come down appreciably, our relatively high target is inconsistent with price stability, our constitutional mandate. True price stability is achieved when households and firms stop paying much attention to inflation when making consumption on investment decisions. We are yet to get there. At this stage, I would like to hand over to Chris Lovald, our Head of Economic Research and the Chief Economist, to take us through a presentation that succinctly puts for you what we have in the monetary policy review. And thereafter, we will take questions from the floor and online. Lovald.
Thank you, Governor. The Governor is optimistic, of course, as always. Succinctness isn't always what we end up with because the world economy is quite a complicated place at the moment. So I'm going to walk through in some detail what some of those complications look like and hopefully a bit about what they mean for us. Before I start, I just want to thank all the SARB staff who work very hard on this document and the presentation. And because they work so hard on it, I very much encourage you to actually read it. There's quite a lot of good analysis and information in there that tell you a bit about South Africa and quite a lot about the world and the types of analyses we do. So let me thank Witness Mbanangavi and the research team and the communications team and the other teams that support the work that goes into that. So we're starting with watch your step. Basically, watch out where we're going because the world is uncertain. Clearly, the uncertainty is in that global environment. Current conditions look hard to read. Policy is equally hard to read. And that gives rise to a lot of uncertainty about the trajectories that our economies will go on and what policy trajectories need to look like. Global disinflation has slowed. One might argue that it's even stalling. And the open question here is whether or not that will start to reverse. There are certainly signs of it and shocks that suggest it. Global growth itself is modest and arguably fragile. And there are large downside risks staring us in the face. This is likely to lead to stagflation, and stagflation is a set of conditions in which the policy path that governments and central banks need to embark on becomes more uncertain. The policy rule that you want to take is not very clear-cut. Domestically, growth has been very inconsistent. But we see it lifting gradually, and I'll talk a little bit about why that's the case. Inflation, this is the good news part of it, has been contained for some time now, and the forecast, the outlook looks moderate. Rates have been lowered by 75 basis points, and the stance now is above neutral, but close to it. There are, however, a wide range of risks that lead to quite low forecast confidence, and you will pick that up from our monetary policy statements in recent times. So let me move on to a few slides about the global economy and then to the domestic. So I'm going to go through these slides pretty quickly. I've got quite a few of them, so I'm not going to be, unfortunately, as succinct as I'd like to be, but I will go through the slides pretty quickly and just draw your attention to the things that really matter here. In this slide, this is just global inflation. We'll start there. And you can see those blue columns show you what the global inflation outcomes have been relative to the 2010 to 2019 average, which is the dotted white line, and then the October 2024 forecast, which is on the far right-hand side. That's that white circle. In October, we expected global inflation to continue falling, and the outcome is the blue level. So there's about a 1 percentage point difference, roughly half a percentage point difference between global inflation outcomes for 2024 and what we thought was going to happen in October. A lot of that is being driven by inertia from core inflation, which remains quite high above targets in most advanced economies. That's what I'm showing you in this graph. You can see again on that far right-hand side, there's been lots of disinflation, but those yellow, green, red, and blue lines are not closing in on that 2% inflation target, and that's been a concern for some time. Inflation is also stubborn in a range of emerging markets. Here I'm showing you Chile, Mexico, Poland, Brazil, Colombia, and Romania. And all of them, as you can see, again, have seen quite a lot of good disinflation. So those numbers of all those lines have all come down. But they've plateaued, again, considerably above the average 3% inflation target, which is that white dotted line cutting across there. So again, in emerging markets, we've seen some stalling out of the disinflation process. Accordingly, policy is eased, but by quite a lot less than expected. Now, this chart is pretty hard to read, so I'm just going to take one line here. Let's look at the Eurozone on the bottom left chart. So the blue line is the policy rate as of September 2024, so roughly 9 months ago at the time of our MPC meeting. So the policy rate was sitting at around 4%. It was expected to change at that time by the green bar, but what actually changed, by the green plus the yellow bar, so it was supposed to come down by almost a full 2 percentage points, but it actually fell by only the green amount, and you end up with that red current policy rate. And that pattern is what has occurred in country by country, both for advanced economies, which are in the left-hand chart, and emerging markets on the right-hand side. We've all seen more or less the same thing. The one exception here is Brazil, which has had to raise its policy rates back up in response to higher inflation. So policy is less restrictive, and we're showing you this by graphing the change in the ex-ante real policy rate. So this is the extent to which the real policy rate has fallen in countries running from the US on the left to Poland on the right. And again, the exception here right in the middle is Brazil. Poland was also an exception. South Africa is highlighted, and you see that the real policy rate has also fallen there. But measuring this real policy rate and what it ought to be has become very hard. It's hard for a whole range of reasons, both short-term and long-term. This chart shows you the real neutral rate estimates that are provided by the IMF, various central banks, and other forecasters. And those are those white bits in each of these columns. And you can see for countries running from the US, the UK, the Eurozone, Mexico, and Indonesia and Poland on the right, that range is quite wide. The ex-ante real rate is still well above those ranges, which are those red dots, so that's where the forward-looking real rate now sits. And they haven't come down to those neutral real rates, in part because the estimation process of those neutral rates in white is hard to do, in part because there is so much more uncertainty in the global economy. So of course you want those rates to come down, but it's not entirely clear how you get there. Now this graph just shows you what South Africa's neutral real interest rate decomposition looks like. So this comes out of our model and shows you what the constituent parts of that neutral real rate are. Just to take South Africa and focus in a bit more on it. You can see that the equilibrium risk premium, which is the blue, dominates our calculation of what the neutral real interest rate is. For a long time, the G3 neutral rate, which is red, was pulling down on the overall neutral rate. But since we moved to 2023, 2024, 2025, over on the right-hand side of that graph, the G3 neutral real rate has started to add to the overall neutral rate for South Africa. Now, this is an estimation that is prone to lots of error. What I think is interesting here is just how little that G3 contribution is. So if you get a lot more uncertainty coming into G3 neutral rates, then that component is going to rise, and push up South Africa's neutral real interest rate. So the neutral real interest rate level for South Africa is that white line going through the series. So why should we worry about this? Well, one reason you all know is simply that there is an incredible amount of uncertainty out there in the world today. This chart just gives you one very specific lens on that. We're looking at trade policy uncertainty and economic policy uncertainty measured in various ways. The trade is the white and the economic policy is the blue. And you can see two things here. One is simply that the economic policy uncertainty index has now reached levels consistent with COVID environment and quite a lot above what we saw in the global financial crisis. Now, that in its own terms isn't something to necessarily get too worried about, except it says again something about the way in which analysts and the markets are understanding the world around them, and they're very uncertain about it. It goes without saying that the trade policy uncertainty index has reached extraordinary levels, and I think we all know why. So with inflation expectations rising around the world and the possibility of this uncertainty feeding into lower GDP outcomes, it opens up this idea that the global economy is slipping into stagflationary conditions. Certainly the risk of that happening is rising. Inflation expectations are rising across much of the advanced world. You can see that on the left-hand chart. In the UK and the US, the most recent inflation expectations have ticked up quite alarmingly. The Eurozone has also ticked up, but is still relatively low. The problem there is it's reversing what was expected to be an ongoing downward trend. On the right-hand graph, we're showing you global real GDP and what it is expected to be over the course of this year by the Bloomberg consensus for 2025, as well as the headline inflation rate. So you see the forecasters around the world are expecting a significant rise in headline inflation and a significant slowing in global real GDP. Now, one of the things that combination of circumstances or dynamics does is it creates more volatility in financial markets. And again, this point, harking back to this point about uncertainty, this graph shows you a little bit about what that uncertainty actually looks like when it translates into interest rate expectations in advanced market economies. And the takeaway here is simply that these lines all show what was expected to be interest rate cuts in the UK, which is green, the Eurozone, which is red, and the US, which is in blue. And these have changed a lot over just a 4-month time frame. Just to take the Eurozone, for instance, in January, it was expected that they would cut by about 125 basis points, so a very large cut. That collapsed by March to 50 basis points and is now increasing again to something like 75 basis points. So as the markets are reading these different inflation and growth dynamics, they are changing their assessment all the time about what the markets and interest rates will look like in the future. So the policy rate path is now much less certain, but it seems fairly clear that it's likely to remain higher for longer. There are some things leaning against this, and we can talk about them later. For instance, oil prices have come out quite a lot lower recently, and that might provide some better news for inflation going forward, but we could talk about that. The bottom line here is that the policy rates in advanced economies at this stage look like they will end up being a bit higher than expected. What about for emerging markets? Well, when we look at emerging markets, the one variable to add, which means the most in many ways, is the currency, in part because most emerging markets are exposed to currency movements in one form or another. And you can see here that emerging market currencies, by and large, have started to depreciate. quite a bit. There's been a bit of a bounce back. So let me tell you what you're looking at here. The red line is the emerging market FX currency index. The rand is in yellow. And then you've got the Swiss franc in green, the euro in white, and the Japanese yen in blue. So as with this volatility, the dollar has weakened. We've seen emerging markets broadly start to weaken, but other safe haven assets, currencies like the euro and Swiss franc, strengthening. So global growth is quite likely to be modest. There are major downside risks, and it certainly looks more fragile. This graph, just at a very high level, should tell you something about where we are relative to these longer term averages. So the 2010 to 2019 average real GDP growth is in white, and then you've got different parts of the world and what their real GDP looks like. If you look at the far left, that's the world as a whole, and you can see that real GDP growth is remaining well below those averages. And there are some countries that are contributing more to that than others. If you look at emerging markets, which is the second from the far right, emerging markets grow faster than the advanced economies, but they still are quite a bit below 2010, 2019 averages. So the idea that we are sort of turning the corner into much faster growth is questionable. Okay, now I'm going to turn to South Africa. We're going to pivot to South Africa a bit here. So South Africa's performance, as you would have seen on the previous graph, has been pretty lackluster. You all know that. Quarterly growth rates have been inconsistent. And part of the story here is just simply weak productive capacity. One of the ways we measure that is potential growth, which is on the left-hand graph. You can see that red line has been, broadly speaking, if you threw a linear trend through that, it's been going down towards zero for quite some time. If you break this down by sector, on the right-hand side, you can see that the only sector that has really recovered in a durable way from the 2020 levels, the pandemic, is the tertiary sector, and that's in pink. Primary sectors had a lot of volatility, driven both by mining and agriculture, but the secondary sector, which is in yellow, has been and remains pretty depressed. Broader demand and supply, both are contributing to this, to a weak investment profile, and that investment profile is pretty critical to growth, as I will show you just now. If you look at this graph, you can see whether it's general government, private sector in blue, or public corporations in red, those real gross fixed capital formation levels remain, again, way too low. So bottlenecks, and this is something we've talked a lot about, tend to weigh down the economy and weigh down investment. On the left-hand side, we're just showing you the weekly energy availability factor. We saw quite a nice improvement, so that blue line picked up through much of 2024, but it's fallen down again, and that leads to uncertainty for private sector companies and investment. On the right-hand side, a similar kind of story on cargo, which you are all familiar with. So from a growth perspective, what this really means is that it leaves the consumer having to do the heavy lifting on growth, and they've done a bit of that. So there are different kinds of drivers of this. Some has to do with real disposable income. On the left-hand graph, the white line rising. Part of that is a rise in real household net wealth, which is the red. Part of that is the withdrawal from the two-pot system, which is showing you the actual rand volumes on the right-hand side. When you get up to 45 billion, you're talking about roughly just over half a percentage point of GDP. And then in the middle graph, you can see that households have responded to these improvements in real disposable income and access to credit. I'll show you that just now, by boosting real retail sales. And that's that green rise in retail sales in index terms right in the middle of the chart. So one takeaway from this is that rate cuts, among other things, are adding to this better household consumption profile. You can see on the left-hand graph how the green is 3-month on 3-month seasonally adjusted rises in real household credit extension, and that has picked up reasonably well very late in 2024 and into the first months of 2025. And then on the right-hand side, a little bit more volatility, arguably in corporate credit extension, but you can see a nice grouping of blue columns that are positive, and that red line, which is the year-on-year growth rate, is picked up quite solidly into positive territory. So there is some movement there. Part of the story I referred to earlier is just simply that household spending growth is being sustained on improved finances. And so I wanted to show you a little bit, hone in a bit more on the real disposable income line, which is that graph on the left-hand side. So the blue line is the rise in real disposable income. So one way to think about this is just simply that here's your revenue and your income, your earnings, your wages, and then with inflation falling, your real purchasing power is rising and your real disposable income is rising. So that's doing the right thing. In the middle, you've got another version of the real credit extension story. Most of the credit extension that we've seen that's growing is in the short-term credit, so that's the red line. Total credit is in green, and the long-term credit, which is your housing and that kind of investment, is in yellow, and that still remains. It's picked up quite a bit, and it's in positive territory, but it's still fairly low. And then you get to real consumption spending on the right-hand side. So these are the numbers that feed into the forecast. And you can see that we've had a bit of a pickup into 2022, 2023, and 2024 on the far right-hand side. And those dotted pink dots there are our forecasts going forward. So medium-term growth is expected to lift to around 2%. We'll still get not a lot of movement out of public spending. We don't count on a lot of movement in net exports. They seem to, in our forecast anyway, we expect them to be relatively neutral. But what's worth taking out of this chart is just 2024. Let me take a step back. The blue line is that household consumption. So I've been telling you a story about how household consumption is strengthening, and you can see how it plays itself out in the forecast. Going forward, it contributes a large chunk of the growth. We also expect total investment to start to pick up a bit more strongly, and that's the red components of those bars. But if we look at last year, we see that investment was quite negative, but we benefited quite a bit from household consumption, and we benefited quite a lot from net exports. And what was driving that net export line was an improvement in the terms of trade. So where does that improvement in investment in our forecast start to come from? Again, this will be familiar to all of you reading the paper on a regular basis. Private sector generation initiatives shown on the left-hand side are quite substantial. We've seen rail tonnages start to improve. That's in the middle graph, and the expectation, the forecast coming out are those red dots. So those rail tonnages are meant to increase quite a lot. And all told, with private sector investment, we should get a stronger real investment profile, and that's the yellow forecast on the right-hand side. So demand and supply, turning now a little bit more to monetary policy, has broadly been balanced. This is what our famous output gap estimate looks like. So this is the balance between demand and supply, looking backward over time and forward into the forecast. Now let's turn to inflation proper. Inflation surprised to the downside in the past 6 months. The governor referred to that earlier. If you looked at our forecast in September 2024, that would be the blue line. If you look at our forecast now, you get the March outcomes, which is the white line, and the dotted line going forward. So a little bit hard to show this to you, but there's a bit of a gap there between the blue dotted line and the white solid line. So that shows you the discrepancy between what we forecast and what the outcomes were. We spend quite a bit of time in the MPR talking about forecast errors. We do that quite a lot these days. And I wanted to just talk a little bit about where those forecast errors come from, because that graph I showed you previously, arguably there was a forecast error. In essence, it comes from components and how they have moved over time. It also comes from a turning point in the inflation trajectory, and it comes a little bit from policy, and I'm going to talk about each of those quickly here. So from a components point of view, this chart just shows you, well, so where did we get things most wrong? Arguably, I think it's primarily red, which is the core goods component. And what this really reflects is that for much of 2022 and 2023, we expected more exchange rate depreciation than we actually saw, and that did not feed through as much into core goods. And so our inflation forecast was a bit higher than it should have been as a result of that. When we move into kind of the latter part of 2023, in the middle of that graph, it starts to look like fuel prices is where we were a bit off. They're notoriously volatile, but it's easy to get them wrong, but that contributed to quite a big chunk of the forecast error in our September 2023 meeting. And then things like services, which are in green, have contributed to the forecast error more recently. So on the right-hand side into 2024, and a lot of what was going on there had to do with housing prices and other components of services, which ended up coming out lower than expected. Now, the SARB is not alone, of course, in getting these forecasts wrong. The yellow line, so the white line is the SARB forecast error, and the yellow is the Reuters consensus. And you can see that both Reuters and the SARB were kind of getting things wrong in the same kind of way. And part of that is just simply the turning point story. So inflation peaked at the end of 2022 and into 2023, and then started to come down. But as forecasters, you tend to look at what you've got right in front of you, and it's very hard to get the turning points right. And so the SARB, like other forecasters, expected more inflation than actually came through, fortunately. Policy also played a role in that, but I'll come to that just now. So this graph just shows you the specific contributions to the more favorable price developments. And you can see here how red, which is that core line, core goods inflation I referred to earlier, starts to moderate from about 2023 on. You can see how food, which is the blue, really comes down very sharply in the middle of 2023 and then continues to weaken in its inflationary impulse through into 2024. And even electricity, which is the yellow, starts to come down a little bit. So we expected higher electricity price inflation than actually occurred. And then the green is fuel itself. And you can see on the far right-hand side how volatility in oil prices contributed to quite a sharp pull down in the headline inflation rate. So that's that white line coming down quite sharply near the right-hand side. So you had actually deflation in fuel prices in certain months. Policy also played a role by impacting on the currency level. So the policy operates in part through the exchange rate, in part through inflation expectations. And so the exchange rate measure on the left-hand chart is the nominal effective exchange rate, and that came down quite nicely into the early parts of 2024. That's that yellow line coming down, and that helped to pull down core inflation. And as that came down, underlying inflation more broadly, our different measures of it also came down. So the right-hand graph shows you, again, core inflation, which is the blue line, and then it's set against the range of measures that we trotted out last year, super core inflation, trim mean inflation, and our persistent and common component of inflation, which gives us that range, which is that white bit, which is the spread between a gray bit, the spread of estimates from these different core measures. And again, in a gratifying way, they are all coming down and moving back down to 4.5%. So inflation is seen bottoming out this year before reverting to the target midpoint sometime in 2026. As usual, we break this down. The blue is the headline inflation, and we break this down into the core, which is yellow, and the non-core, which is red. And a point we've made many, many times in the past is that non-core inflation, fuel prices in particular, but other components, drive a lot of the volatility that we see in the inflation rate. So that forecast enables policy to settle around neutral, and that's what we're seeing here. So as headline inflation settles around that 4.5 mark, which is that white dotted line, the headline inflation is in yellow. You can see the nominal policy rate, which is in the greenish blue color on your green on my computer, blue here. It continues to ease down to around 7.25%. Last two slides. Market volatility, however, continues to spill over into risk in the near term. Sorry, this is not my last two slides. I have a few more to go. Market volatility continues to spill over into risk in the near term. So I showed you very early on what some of that market risk look like in advanced economies. Here is two quite different stories being told in two different measures of risk. One is the emerging market bond index with South Africa on the right-hand side in blue, and that's rising. So what the market is telling us is that there's quite a lot of risk premium priced in. And then on the left-hand side, the forward rate agreement, which gives us a forward view of interest rates, is starting to say that inflation growth, is likely to dominate inflation in the forecast going forward. That remains to be seen, of course. There are some tailwinds to inflation that we worry about that come from rising production costs, driven in part by things like the VAT going up, and that's on the right-hand side, our estimates of the VAT increase. We've compared our estimates for 2025 and 2026, which hover around 0.15% for 2025, going up to about 0.25% for 2026, to the 1 percentage point VAT increase in 2018, which generated an increase in inflation of around 0.4%. The other tailwind, of course, is exchange rate pass-through. So if we start to see a lot more currency weakness, we can see that passing through into those various components of inflation that I talked about earlier, and that's what I'm showing you on the left-hand graph. You can expect that things like food prices, core goods, and fuel, which are blue, yellow, white, and blue respectively, starting to increase again, whereas services tend to be impacted by exchange rates with a bit more of a lag, and that's the red. So I wanted to talk a little bit about the scenarios that we've done recently. We've actually done scenarios for quite a long time for the MPC meetings, but it's become very fashionable to talk about them now, and every central bank has to trot out their scenarios. So I thought I would just show you what some of those scenarios have been and kind of what the punchline for them has actually looked like going back in time. So in the November 24 MPC meeting, that's the left-hand chart, we did a range of scenarios looking at geopolitical tensions and whether they would de-escalate or escalate, and we set that off against a higher admin prices scenario. So the de-escalation scenario is in yellow, and you can see inflation coming down there on the back of stronger exchange rate outcomes and better growth outcomes. You can see tensions escalating in blue dotted line, pushing inflation up, and then you can see quite a strong increase coming from a very local contributor to inflation, which is higher admin prices, being quite a lot significantly larger than the tensions escalate. But of course, A lot of this depends on the assumptions you make and the magnitudes that you end up with. In the January 2025 MPC meeting, we looked at a higher tariff scenario, 10 percentage points on all imports to the US, and that's the blue line, and you get a stronger pickup inflation from that because it's across the board worldwide. And then we looked at what would happen to inflation from a speedier resolution and a strengthening of OV reforms, and you get a bit of an inflation improvement, as you might expect, in the outer part of the forecast period. That's that red dotted line falling below the baseline, which is white. And then in the March meeting, we looked at, among other things, I'll get to the other things just now. One of the things we looked at was a weaker US dollar and higher commodity prices. So this was kind of a more positive scenario, if you will. Again, South Africa quite responsive to higher commodity prices, which puts up the terms of trade and generates, again, an exchange rate positive effect, which feeds through into better growth and stronger productivity growth and lower inflation. We also looked at another set of scenarios involving AGOA in the last meeting. And there were three versions of this. One was just simply with the AGOA loss, what would happen to inflation, so that's blue. It's very hard to see because there's very little action there. The red is AGOA loss plus a 25% tariff increase. And again, you get a little bit of a decline in inflation, and that starts to reverse itself later on. So this is very much driven by growth effects pulling down on inflation. And then the green is the AGOA loss plus the 25% tariff increase, but then we add in quite a large risk premium shock, which generates quite a lot of exchange rate depreciation, and not surprisingly, you get a much more adverse inflation outcome, which is the green, going up to 2% over the course of a year. So these different scenarios on balance, and if you watch them quite carefully and added them up, you will notice that on balance, they tended to generate worse inflation outcomes than better. And this has led to the MPC being worried about their confidence in the medium-term forecast, more concerned about how confident they would be about the medium-term forecast. And part of the reason for that is just simply that any one of these scenarios that are negative highlight or risk exacerbating the cost of rising uncertainty and yields that we've already seen and how they feed back into the exchange rate. So these are not forecasts, these are actual numbers. The left-hand graph shows you the South African government bond yield curve, and you can see how between October, which is in red, 2024, through to the 9th of April, 2025, so very recently, we've seen quite a strong rise in long-term bond yields across the curve, as well as on the right-hand side, a lot of exchange rate depreciation against the US dollar. So let me conclude with a few questions. So you don't have to answer them, but I think they're open questions for all of us. So disinflation is clearly slowing. Will there be a tariff-induced surge? We don't know the answer to that yet. We'll hold our breath. Stagflation risk is rising, and that raises a question about how credible is your central bank. So how much experience does your central bank have with dealing with that combination of low growth and higher inflation? Do emerging markets have the policy space for a sustained response as the world goes into more uncertain and adverse conditions? And then finally, our inflation forecast is certainly better, and in particular, if we look back at it, the current inflation rates are on a monthly basis, continue to come out very positively and low. And the open question here is, can we make it stick? What's the combination of policy moves and outcomes we'd like to see to continue to get that trajectory behaving, inflation trajectory behaving the way we would like it to. Thank you very much.
Thank you very much, the good doctor. At this stage, I would like to give you an opportunity to raise any questions that you might have to the panel. Any starter, Yani Risto.
Thank you, Governor. My name is Yanni Rousseau from Wits Business School. At the outset, before I ask my question, Governor, congratulations on your new role, your election as Chancellor of the University of Stellenbosch. We wish you success in that role. They can be as successful with you as Chancellor as you are as Governor at the Reserve Bank. They have a great future ahead of you. Governor, turning to my question, I've now reached the conclusion at this stage that there's never a normal year in financial markets. We have to accept that. So all the Reserve Bank can do is lower inflation. So is there any obstacles or are there any reasons why South Africa cannot get a lower inflation target of say 3% per annum at this point in time? What is preventing the announcement of such a lower inflation target? Thank you, Governor.
That Azajamin.
Thank you, Governor. First question is, how confident are you that gross fixed capital formation is going to accelerate over the coming year and the next few years to help lift economic growth? Because that is obviously at the heart of the upward revision of growth forecasts. And we saw last year, the year before, well, especially last year, the same thing happening where we forecast much higher fixed investment and it turned out to be negative. And the question I ask here is, how much have you taken into account in your growth forecasts? Is it a historical forecast or is it up to date, given substantial downward revisions on what's going to happen globally over the past 2 weeks in the light of what has happened? And allied to that is, what have you assumed in your different scenarios about the duration of tariffs and their impact? That's a very general question, I know, but just give us a flavor of what you've assumed in that regard. Thank you.
Are those the only two interested? Okay, there's a young question here.
Thank you, Governor Pima Dabani from UP. Just a question, does the National Treasury also with the Parliament consult the Reserve Bank when they consider policy changes like the tax rate? And also, as we have heard that there is an envoy to the US to try possibly mend the relations between South Africa and US, would the Reserve Bank also get updates on that, or has it been consulted, or do you have a representative also to liaise with the central bank that side? Thank you.
Okay. This being the first edition, Chris, I'm not going to do your job. How confident are you with your forecast on GFCF? Just for context, there was a debate raging on the sub-email system this morning, and I'm sure he will give you a flavor of the nature of that debate. So I will give that to him. And Theo Janse van Rensbeck. Scenarios are not forecasts. And although you are responsible for the forecast, I'm also going to give you scenarios to talk to the scenarios and what you have assumed in terms of tariffs, just in case there hasn't been another announcement changing the duration, because this happens with a lot of frequency. Yanni, thank you very much for that congratulatory message. It made a lot of Stellenbosch alumni in the central bank green with envy. They wished they only graduated this year so that I could keep them. But unfortunately, they are here, so they could only take pride in that. Are there any reasons why South Africa cannot have a lower inflation target? I can't find any. But I have spoken so much about this that I have checked that the narrative says that the governor prefers. The central bank discusses this, and maybe I am not such a good teacher. DG Rashad Kasim is a very good teacher, and he is going to explain that. He is going to explain that to you. My young man from UP, not UJ, right? UP. Okay. The National Treasury is under no obligation to consult the Reserve Bank in terms of the proposals they make. We do engage with them on their forecast as part of our normal discourse with them. And the forecast is meant to try and understand, the discussions is meant to understand how the Treasury has arrived at its forecast and how the Reserve Bank has arrived at its forecast, and what assumptions were made by both institutions and what the differences are. And it's just meant to enrich the forecast conversation in the two institutions, but each institution will still submit its own forecast. Special envoy of the president to the United States, that's the president's prerogative. We do not get involved. And do we then also do the same with our counterparts in the US? The beauty of central banking is that we do not need ambassadors. It's a DIY shop. Do it yourself. So as central bank governors, we meet 6 times a year under the auspices of the Bank for International Settlement, and that's where we would engage with various central banks, including the Federal Reserve. We also meet 4 times a year under the auspices of the group of 20 ministers and central bank governors meeting, and we exchange views there. The US Federal Reserve Bank hosts an annual meeting at some obscure place, village, called Jackson Hole, once a year, normally in August, that we engage with the Fed there and we exchange views. And if that is not enough, I will pick up the phone and call my counterpart in the US and says, can you tune me in on this or that? Or he would do the same. Unlike ambassadors who, after they had met, they issue something called, before they meet, they issue something called a note verbal, and after they have met, they meet, and they will come with a statement that said, we met and exchanged views about issues of mutual interest that affect the two countries without specifying what those are. We do not have to do that as central banks. We meet, we discuss the issues, and then we take what we can take from each one of those. Put simply, The engagements between the central banks is a continuous one. And in addition to those high levels, the officials beneath the governors interact and they speak to their counterparts throughout the year, including if the Fed has put in a forecast or a thing that our team could contact the team at the Fed and says, can you clarify what do you mean by this? So the conversation in central banking is a very collegial one. It's like the best space, most secure space to be in, because you will not hear Jay Powell talk about how badly or how well the South African economy is doing, or how well or how badly the South African Reserve Bank is doing in managing inflation in South Africa. And you will not hear the South African Reserve Bank say any of that sort. The decorum is very simple. When asked about what I think about the US economy, I will tell you the best person to say it is Jay Powell. And if you ask him, he will tell you, go and speak to Lesetja Kganyago about the South African economy. It's such a nice space to be in. It's not like the political space. And so part of it is that we are technocrats. And because we are technocrats, we know we have got security of tenure. And we can have our honest conversations without any fear of reprisals. And for most central banks, they are expected to act independently and without fear, favor, or prejudice. And it is a space that we protect for ourselves. Chris? No, let me start with Theo, Chris, and then DG Kasim.
Thanks, Governor. The answer to the question on the tariffs is pretty simple. We assume that the tariffs is going to be permanent, so whatever change we've made on those assumptions, they stay there forever. I think the important thing here is to realize that our exports to the US is pretty small. Of our total exports is about 7.5% going to the US. Of all those exports going to the US, only 25% of them benefit from AGOA. So that's why when Chris put up those graphs, you could see when AGOA comes to an end, the impact is very small. And even when you add a 25%, it still stays relatively small. Obviously, it gets a lot bigger when you add an exchange rate depreciation to that, coming from a higher risk premium. Not quite a question, but something that we're currently working on. Obviously, things are changing a lot. I think the important thing here to realize is it's quite a different scenario when the whole world is facing new tariffs. And that impact is going to be considerably bigger than when only South Africa is impacted, because that impacts global demand around the world, and that's going to have a much bigger impact on our outlook and so on. But that's stuff we're still working on. Thanks.
Okay, as we go to Chris Lovald, that was a very complex way of saying that the question that we have always been confronted with was, what happens if South Africa gets kicked out of AGOA? The tariffs have eliminated all the benefits of AGOA. So.
Yes, okay, sorry. On the question of confidence around investment, not very is the short answer. If you look on page 28 of the MPR and you compare the numbers there to the CPI forecast misses that we had, they're much larger. And page 28 gives you a chart that shows the extent to which GDP is overestimated and underestimated. And there's some good news in that chart, and bad news. The bad news is that we consistently overestimate gross fixed capital formation. The good news is that we continuously underestimate the contribution of net exports to growth. So there is something offsetting our bad investment forecasting. Now, what's the problem here? Part of the problem is just simply that we rely quite a lot on our gross fixed capital formation numbers on what we think is going to happen in public sector state-owned enterprises and in general government. And you will know that there's been a lot of volatility in both those components of investment. In particular, in 2024, they were quite weak. And then you add on to that what you think the private sector is going to do and what they are actually responding to. And so part of what they're responding to, and which has been a problem for a long time, is long-term borrowing costs. You can think about South African government bond 10-year yield as being a proxy for what corporates might pay for long-term investment, and that's been very high for a long time, so it's always dampening down on gross fixed capital formation. And then you get a positive feed through, hopefully coming from your GDP forecast. So when household consumption rises, GDP rises, and you also get an investment response as well. But again, these things have been really inconsistent and volatile. I'll give you just one last kind of window on this. The last big increase in private sector investment we saw was in response to the need for embedded generation. And so you had Eskom delivering less electricity and the private sector taking advantage of deregulation to put a lot of embedded generation on the table. So suddenly the private sector investment numbers went up and gross fixed capital formation bumped up as well overall in response to that. And then Eskom started to do better and deliver more electricity, and suddenly the investment in embedded generation completely seemed to have dried up, or at least stayed at a very flat level and didn't increase anymore. So private sector investment, which is the main component in the overall gross fixed capital formation, is very volatile at the moment and very hard to read. Again, just to reflect back on the subtext of this presentation is that there's a lot of uncertainty out there, and we know that private sector investment in particular responds very elastically, very much to uncertainty. Uncertainty goes up, investment goes down. Thanks.
DG Kasim?
Thank you very much. I'm not sure if that was a naughty question or a profound question, Yanni. I guess you were not asking what are the benefits of a 3% target. Your question was very specific. What are the obstacles of getting to a 3% target? Let me just say that there could be two obstacles. One is you've got to get alignment with the Reserve Bank and the Treasury. The second obstacle is a technical obstacle of some differences about how you get there. So it's not about getting there, it's how you get there. And I think that those technical differences are several. We actually began a process of addressing those technical differences by organizing, as we do in this country, a conference to talk about these. For those of you who have not seen, these are all on video. They can be on our website, all the sessions, and I think there are some really interesting sessions. I think very few disagreed with the notion that the inflation target around 3 makes sense. In fact, one paper even went to 2, which not many agreed with. I think where there were differences is how you get there, and economists use a very obscure term called the sacrifice ratio. What is the economic growth or economic activity you have to suppress to get a lower target relative to the current target? So there are some differences on the sacrifice ratio. There were a few different views about it. There were some differences about whether you get alignment with admin prices and whether admin prices, sticky admin prices, which, like electricity inflation above 11-12%, puts a bit of a burden on relative prices to adjust when you bring your target very low. So how do you deal with that concept? The one view was you cannot tolerate the admin prices. The other view was, well, that by not tolerating the admin prices, you may be able to get admin prices lower. So these are the kind of debates that took place, and I think that there was also a view that currently inflation is close to 3%. So let the economy do the work for you. So this is what came out, and I think that one of the issues that both us and Treasury were agreed on is let's have a bigger process. Let's get more technical experts to look at various facets of what it means to get to low inflation target. How quickly, how long does it take? Do you do it suddenly? Do you announce it in 3 years, 5 years? Is there kind of a glide path and so on? So these are the issues. Chris and his team are putting together a report from the conference, and then there'll be a continuous conversation with the Treasury on the different issues and build some consensus as to what we think needs to be done. So that's where we are at. I think that that's the process so far. Thank you.
You just confirmed you are a very good teacher. Mapule, are there questions online?
Yes, Governor, we have a couple of questions from Putela Miene on YouTube. The first one says, the Titanic sank plus 100 years ago. Are President Trump's tariffs our proverbial iceberg, or is it possible to broker more favorable trade agreements within 3 months? The second one, do emerging markets have a unique opportunity to increase manufacturing capacity, potentially offsetting the impact of inflation? And then the last one that I will read from here, what is a reliable predictor for consumer spending? Thank you, Governor.
Is that it? No more questions in the room? I don't know much about the ocean. I'm not sure I will help with the Titanic.
Good afternoon, Governor. Next month, the MPC meets. I've got 2 questions. The first one, will they reduce the rate next month? I asked the question based on the following. VAT is going up by 0.5%. With the result, goods and services will cost more, people will be spending more money. With the result, inflation will go up. So the question is, how will the rate cut, most probably next month, help with keeping the inflation rate at 3%?
Azar Jamin, oh no, there's a new hand here, there's a new hand there. And then go to Azar Jamin on the other side.
Thank you, Governor. Tafadzo Chipanguza from the steel and engineering sector. My question is, while I understand the risk of the loss of export markets through AGOA, etc., particularly from the steel sector, there is a concern that as, for example, the US closes and other markets also put up tariffs, that product will be then destined for small open countries like South Africa. So the concern then is, while I understand that will deteriorate your net exports, there's also the concern that those imports will also kill productive capacity domestically. And I would be interested just to find out how you are thinking about that from an overall growth perspective, especially from the contribution of manufacturing. And I think that problem is wider than just the steel sector. Thanks, Governor.
Governor, sorry to hog the mic again, but I suddenly realized it is quite relevant to ask you whether you have done any research or give an opinion on the impact of the two-pot retirement scheme on consumer spending. Some of the data that have been released in recent months have been amazingly strong, which speaks to the potential boost from that source over and above what you showed up here in terms of credit demand and lower interest rates. And do you have any view on a potential dissipation of this boost to consumer spending and its timing? Thank you.
Thank you. DG Mampomudisa is a better cook than me, so she will deal with the two-pot system. Young man.
Good evening, ladies and gentlemen. I'm a pupil from Hoërskool Elandsport, and my question for today is that through the emergence and the alliance from the BRICS with China and South Africa, from the webs we know that China has the lowest inflation target or the inflation rate. So since we have an alliance with China, can't we adopt any skills or any decision making that they make in order for them to make their inflation targeting to be as low so that we solve the economic problem as a country?
Okay, I think that I should take this from here. Reliable predictor of consumer spending, you can't pick one. They varied, and at any particular point in the economic cycle, certain drivers might have a more dominant impact than the others. In the presentation that we had talked about the impact of the increase in the net worth of the households, the impact of the increase in the disposable income, and that disposable income is real disposable income. So part of the big driver there had been a decline in inflation, because when you have a decline in inflation, you are freeing up income for the households. And DG Mampo will talk about the impact of the two-pot system, which for all intents and purposes is a drawdown of savings. So savings is basically like deferred spending. By drawing on that now, you are bringing that spending to today, and it will drive today's spending. But it might reduce your spending in the future, because that is not income. You are drawing on what you had saved. In the past. And lastly, is the attitude of the consumers and households themselves, which as economists we will characterize as consumer confidence. The more confident people are about the future, the more they feel they can spend now, because they want to prepare for the future. And that had tended to very much also track what happens to spending. There was the question of this about the Titanic and the increase, how we would do it to increase the manufacturing. I'm not sure the Titanic will help us to increase manufacturing, but let me say that as the central bank, our policy affects the broader economy. What drives sectoral policies, sectoral growth, are the decisions taken by government with respect to those sectors that drives that. And so we do not target sectors. Our job is to smooth the variability of economic activity and of pricing. But this question also relates to the thing about loss of export markets and steel and the killing of domestic output. It just strikes me how the South African businesses would react to the imposition of tariffs elsewhere. It is not long ago that our businesses were calling for the increases of domestic tariffs. And if I might help to jog your memory, at some point I'd warned, don't think you can do this and assume that the others would not do it. And now that consequence is coming to break us. Forget the calculation of how accurate it is that we have tariffs against US manufacturing and all of that. The truth of the matter is that we had been increasing our tariffs since 2009. We had increased it in different sectors. A tariff war is something that no country will win. We can only all be losers. And if you think that you can increase tariffs and thus protect your own industry and thus grow it, damn it, we have been spectacular failures. Because we have imposed this tariff since 2009, we are in 2025 and we are still complaining about it. So let's get things clear. If you want to play in the big league, you play according to the rules of the big league. And the rules of the big league is that you have got to build competitiveness. We cannot even think that we could respond to the US tariffs by imposing tariffs ourselves. We should be asking difficult questions and starting very difficult conversations as South Africans. How do we become competitive? And to your point, that others who can no longer gain access to the US are going to look and say, where can we sell? And they will look and they might be selling us, they might be selling here. And when they sell here, we're going to say, what? You can't sell here? What are we going to do? Impose tariffs on those countries. That means that we are assuming that those countries will not react either. And they will react. What we should be asking is, when tariffs are imposed, who pays the tariffs? It's not the exporter. It's not the exporter. If a Chinese exporter sells steel or steel components into South Africa cheaper, and South Africa decides to impose tariffs and make Chinese steel coming into South Africa expensive, the Chinese exporter is not paying for it. It's the South African importer that is paying for it. The question is, why is China producing steel cheaper than us? Do they have better technology? Do they have better skills? And if they do, our response should be to get better technology and develop better skills. Imposing tariffs is not going to do it. And so far, our response as South Africa had been very measured. Say that this is a tariff war that is taking place. We are not part of it, and as we say in my language, if two giants are fighting, don't try and come in between them. Sit on the side because you are not as strong as them. That's what we do. VAT. I'm struggling. Did you say VAT will lead to higher inflation? Surely if it leads to higher inflation, the response of the central bank should be to respond to higher inflation. And the tool you have is the interest rates, and that means you must increase interest rates, not cut them. But we didn't, and we are not going to. Why? Because we treat an increase or a decrease in value-added tax as an economic shock. It has an impact on the level of prices rather than on the rate of change of prices. And so the imposition of that will lead to an increase in prices with effect from the 1st of May. That's why it will kick in. Unless you didn't get the SMS, I do get the SMSs. And when that happens, the prices would go up. And next year, at the same time, that should level off, unless something else happens. which is second round effects kick in, which means that producers take advantage of that and see it as a scope to continue to increase prices, in which case the central bank must respond to those second round effects. So we will not respond to the increase of VAT. We will see it as a shock that will get out of the system. We will only respond to the second round effects. And before I get into trouble, the sub-team did a calculation of the increase when the VAT was proposed at 2%. And the calculation was that it will lead to an increase in inflation of 0.21. Theo, 0.2. Okay. The point here is that when I say that now that it is no longer 2%, it's 0.5% and 0.5%, the figures change, but it doesn't follow that it is such a straight line. Okay, that is the sum of it. Theo hides these figures. After this, just go talk to him. He will give these figures. He will give these figures to you. Young man, should we all become Chinese? That is also quite something, because I hear things in South Africa in our discourse. China has done this, we can do it. China has done this, we can do it. And we fail to comprehend something. You are talking of a country with more than 1 billion people. So if they decide to close themselves in and produce things there, they have got a market of 1 billion people. There are only 60-odd million of us here. We do not quite have that option. And shall I say, at the moment, Chinese universities are producing more physicists, more engineers, more biotechnologists, more mathematicians than the US universities do, or any other in the world at the moment. So that tells you they are building competitiveness. It's the PhDs that produce the knowledge, and they are chaining these PhDs like there is no tomorrow. Do we want to be China? Can we produce as many PhDs as they do? We can't. But you had an easier part of your question, and your easier part of your question was, they have got such a low inflation, can't we get a low inflation like them? Of course we can get low inflation, not just like them, we can even do better than them if we get efficiencies in the economy and we are more productive. Alternatively, we can simply import their inflation, which means that we start importing from China things that China produces cheaper than us, and then you'll have the benefit of lower Chinese inflation. Is that a sustainable model? Not sure. We just can't be Chinese. It's a completely different economy, and we need to take cognizance of that. DG Mudisa, can you cook for us?
I will do my best, Gav. So when we started with the work on the two-pot system, there were 3 things we needed to think about. The first one was the quantum, how much people are going to withdraw. Is it going to be sustainable, or will it be a shock and go down in the couple of years? Secondly, we had to look at the tax implications, how much of the withdrawals will be impacted by tax. And thirdly, we had to look at the split between consumption and debt. So when we started with the initial estimates in our September MPC for 2024, we estimated around 40 billion. and going down to 21 in 2026. But when we then started getting the numbers in our November MPC, we realized that we underestimated the quantum, and we did some revisions, but we only increased it by about 10 billion in 2024 to 27 billion in 2025. What that meant was we had to revise the implications on household consumption. So basically what we had in the November MPC was that the split between consumption and debt was 75% on spending and 25% on debt. And with that split, the contribution to household consumption was 0.3 and lowering to 0.1. When we got to the January MPC, we then looked at the numbers and see what the withdrawals were. So basically between September and November, we saw about 450 million withdrawals daily, amounting to about 35.1 billion, but that has slowed significantly. In January, we're just looking at 115 million, and February was even lower at 67 million. So the path that we had in our estimate is correlating with the numbers, because we had an initial jump and then a slowdown in the uptake. So in our recent MPC, we didn't revise the estimates, but what we're going to look at is going forward. Do we still think that we will get to the 25 billion for 2025 and 27 billion for 2026? But for now, we think the estimates that we have are aligned to the outcomes that we see, and if there's any changes that we need to implement, then we will do that in each MPC round. Thanks, Gav.
I'm afraid there haven't been enough questions for all panelists, but with that well-cooked meal, let me call this to a close and say to you there are refreshments outside, and we can continue the conversations there. Thank you very much for your attendance physically here and online.